bond markets have repriced the outlook for rate cuts. In the US, at the beginning of the year, markets were pricing in close to 6 rate cuts for this year. That seemed a little bit excessive to us at the beginning of the year. Where we are now, we are pricing in closer to 2 rate cuts for this year. That looks closer to fair. Similarly, on the ECB side, we are now pricing in closer to 3 rate cuts this year. That again looks closer to fair, given our expectations that inflation in the Eurozone will come closer to 2% by the end of this year. I think in that backdrop, now that the market pricing has adjusted to reflect what we would think kind of expected path of rate cuts, the bond market is looking quite attractive. There's a scenario where the central banks don't have to deliver as many cuts if inflation continues to come in above expectations. But generally, given the cheapness, bond market is starting to look quite attractive.
But Mohit, I mean, in a week when traders bet on fewer and slower interest rate cuts globally, you're absolutely right that the European Central Bank really, stood out and bucked the trend. But the hawkish policy from U.S. really poses a challenge for policymakers, including the ECB, does it not?
I think not as much. I think post-pandemic, what we saw was a global surge in inflation. Central banks across the globe hiked rates in a coordinated manner to address those inflationary pressures. Where we are now, we are likely going to see a little more divergence in the trajectory of inflation. And given that divergence in the trajectory of inflation, central bank policies can also diverge. So in that scenario, you could see ECB deliver cuts when the Fed does not, or even ECB can deliver cuts at a pace that is somewhat faster than the Fed because of the differences in the inflation trajectory in the Eurozone versus the US.
So, Mohit, what is exactly the right way to play this ECB-Fed divergence? And actually, I know you were making the case also for owning treasuries, but what's the case against it?
Yeah, I think the case against it would be just if the inflationary pressures persist in the U.S. It can certainly happen. I think for now we are modeling closer to 3.5% inflation in the U.S. by the end of the year. If that happens, Fed funds at 5.5% still look high relative to longer-term neutral. So central banks can still cut rates even if inflation is above central bank's target. But if we start to see more reemergence in inflation, particularly on the service side, that could lead to a little bit more weakness in the treasury markets. On the ECB side, I think there is a little more divergence in the data. You can see from the inflation trajectory, likely by the end of this year, inflation in the Eurozone would be closer to 2%, and that should give ECB the confidence to deliver cuts. Now, if the incoming inflation and the wage data comes out stronger than forecasted, then the ECB may not need to deliver those cuts.